The landscape of Social Security benefits is poised for significant transformation as we approach 2026, with multiple adjustments that will reshape how Americans interact with this critical safety net program. These modifications extend far beyond simple numerical adjustments, representing structural changes that will influence retirement planning strategies for millions of current workers and beneficiaries alike. Understanding these upcoming changes becomes essential for anyone approaching retirement age or currently receiving benefits, as the financial implications extend into various aspects of retirement security. The modifications scheduled for implementation touch every major component of the Social Security system, from benefit calculations to tax obligations, creating a complex web of interconnected changes that demand careful consideration and strategic planning. The cost of living reality, modest increases amid rising concerns. The annual cost of living adjustment represents one of the most closely watched aspects of Social Security, as it directly impacts the purchasing power of millions of retirees. For 2026, preliminary projections suggest a modest increase in the range of 2.7%, representing a slight improvement over the previous year's 2.5% adjustment. However, this seemingly positive development comes with inherent complications that illustrate the challenging balance between inflation control and adequate benefit support. The relationship between cost of living adjustments and actual inflation presents a paradoxical situation for beneficiaries. While higher adjustments provide increased monthly payments, they simultaneously signal elevated inflationary pressures throughout the economy. Conversely, lower adjustments suggest more stable price levels but may leave retirees struggling to maintain their purchasing power against specific cost categories that disproportionately affect older Americans. Research conducted by advocacy organizations consistently reveals a disconnect between official inflation measures and the real-world expenses faced by Social Security recipients. Medical costs, housing expenses, and essential services often increase at rates that exceed general inflation indices, creating a persistent erosion of benefits' real value despite annual adjustments. This phenomenon has led to growing concerns about the adequacy of current adjustment methodologies in protecting retirees' financial security. The Medicare premium interaction further complicates the cost of living picture, as projected increases in Part B premiums threaten to consume a substantial portion of any benefit enhancement. Current projections suggest Medicare Part B premiums could reach $206.50 monthly in 2026, representing an increase of $21.50 from current levels. This substantial premium increase would effectively reduce the net benefit of the cost of living adjustment, leaving many retirees with minimal improvement in their overall financial position. When applying the projected 2.7% adjustment to average benefit amounts, recipients might expect approximately $54 monthly in additional benefits. However, after accounting for the anticipated Medicare premium increase, the net improvement drops to roughly $33 monthly, demonstrating how healthcare cost inflation can significantly erode Social Security enhancements. Full retirement age evolution, the final phase of a decades-long transition. The year 2026 marks a significant milestone in Social Security's structural evolution, as the full retirement age reaches its final destination of 67 years for individuals born in 1960 or later. This transition represents the culmination of a gradual adjustment process initiated through 1983 legislative amendments, designed to address demographic shifts and financial sustainability concerns within the program. The progression toward age 67 reflects broader societal changes, including increased life expectancy and evolving work patterns among older Americans. Those born in 1959 will reach their full retirement age at 66 years and 10 months during 2025, while subsequent birth cohorts will face the full 67-year requirement. This adjustment carries profound implications for retirement timing decisions and benefit optimization strategies. Understanding the full retirement age concept becomes crucial for maximizing Social Security benefits, as claiming decisions relative to this benchmark significantly impact monthly payment amounts. Early retirement at age 62 results in permanent benefit reductions calculated through complex formulas that consider the number of months between the claiming age and full retirement age. The reduction equals 0.05% for each of the first 36 months before full retirement age, with additional reductions of 0.05% for each subsequent month. The mathematical impact of early retirement becomes more pronounced as the full retirement age increases. Individuals facing a 67-year full retirement age who claim benefits at 62 experience a 30% permanent reduction in their monthly benefits, a substantial penalty that affects their financial security throughout retirement. This reality emphasizes the importance of careful planning and consideration of alternative income sources during the gap years between desired retirement and full benefit eligibility. Conversely, delaying benefit claims beyond full retirement age provides opportunities for substantial benefit enhancement through delayed retirement credits. These credits accumulate at a rate of 0.2% monthly, totaling 8% annually until age 70. For those reaching full retirement age at 67, waiting until 70 to claim benefits results in a 24% permanent increase in monthly payments, creating powerful incentives for extended work or alternative income bridging strategies. Taxation parameters, expanding the Social Security tax base. The Social Security tax system operates within carefully defined parameters that undergo annual adjustments based on wage growth and inflation metrics. For 2026, the maximum taxable earnings limit is projected to increase to $183,600, representing a $7,500 enhancement from the current $176,100 threshold. This expansion directly affects high earners while maintaining the program's funding base amid growing beneficiary populations. The tax limit serves dual purposes within the Social Security framework, establishing both the maximum annual contribution requirement and the earnings base used in benefit calculations. Workers earning above the limit pay Social Security taxes only on income up to the threshold, while earnings beyond this point receive no credit toward future benefit calculations. This structure creates a progressive element within the system, as higher earners pay proportionally less of their total income in Social Security taxes while receiving benefits based on a capped earnings history. The practical implications of the increased tax limit affect both employees and employers, as each contributes 6.2% on covered wages. An individual earning at or above the new limit would pay an additional $465 annually in Social Security taxes, while their employer matches this contribution. Self-employed individuals face the combined burden, paying both portions of the tax for a total rate of 12.4% on covered earnings. Understanding the distinction between Social Security and Medicare tax treatment becomes important for comprehensive tax planning. While Social Security taxes apply only to earnings up to the annual limit, Medicare taxes of 1.45% apply to all wages without limitation. Additionally, high earners face an extra 0.9% Medicare tax on income exceeding specific thresholds, creating complex interactions between various payroll tax obligations. The expanding tax base reflects ongoing efforts to maintain program solvency amid demographic pressures, as larger working age contributions help support growing retiree populations. However, this approach raises questions about the appropriate balance between contribution requirements and benefit promises, particularly as wage growth varies significantly across income levels and geographic regions. Earnings test modifications, greater work flexibility for beneficiaries. Social Security's earnings test represents a unique aspect of the program that can temporarily reduce benefits for individuals who continue working while receiving payments. The test applies different standards based on the beneficiary's age relative to their full retirement age, with more generous treatment as individuals approach complete eligibility. For 2026, these thresholds are projected to increase, providing greater flexibility for working beneficiaries. Individuals younger than full retirement age throughout 2026 face an estimated annual earnings limit of $24,360, with benefits reduced by $1 for every $2 earned above this threshold. This relatively strict standard reflects the program's emphasis on providing retirement income replacement rather than work supplementation. However, the 1-to-2 reduction ratio means that continued work remains financially beneficial, as beneficiaries retain 50% of earnings above the limit while building additional credits toward future benefit calculations. The earnings test treatment becomes more favorable for those reaching full retirement age during 2026, with an estimated threshold of $64,800 and a more generous $1 reduction for every $3 earned above the limit. This adjustment acknowledges the transitional nature of the full retirement age year and provides greater incentives for continued employment during this period. Importantly, the earnings test represents a temporary benefit withholding rather than a permanent penalty. Once beneficiaries reach their full retirement age, any previously withheld benefits are restored through recalculations that increase future monthly payments. This restoration mechanism ensures that individuals who continue working do not permanently forfeit benefits, though the timing of payments may be delayed. The earnings test exemption for those beyond full retirement age creates powerful incentives for extended work, as these individuals can earn unlimited amounts without any benefit reduction. Combined with delayed retirement credits for those who haven't yet claimed benefits, this structure encourages productive activity among older workers while supporting program sustainability through continued contributions. Social Security credit requirements, the foundation of benefit eligibility. The Social Security credit system establishes the fundamental eligibility requirements for program participation, with specific earning thresholds that adjust annually to reflect wage growth patterns. Understanding these requirements becomes essential for workers planning their careers and individuals with irregular employment histories who need to ensure adequate credit accumulation. The basic eligibility standard requires 40 quarters of coverage, typically earned over 10 years of substantial employment. Workers can earn up to 4 credits annually, with each credit requiring a minimum earnings amount that increases with general wage levels. For 2026, preliminary estimates suggest the credit requirement will continue its upward trajectory, reflecting ongoing wage growth and inflation adjustments. The credit earning threshold serves as a relatively low bar for program participation, designed to include workers across various income levels and employment patterns. Part-time workers, seasonal employees, and those with irregular earnings can accumulate credits gradually over extended periods, ensuring broad program access while maintaining meaningful work requirements. Beyond basic eligibility, the credit system influences benefit calculations through complex formulas that consider both the number of credits earned and the actual earnings amounts during credit earning periods. Higher lifetime earnings generally translate to larger benefit payments, though the program's progressive structure provides proportionally greater returns for lower-income workers. Special provisions address unique situations such as military service, disability onset, and survivor benefits, with modified credit requirements that recognize the diverse circumstances affecting American workers. These accommodations help ensure program accessibility while maintaining the fundamental principle that benefits reflect meaningful workforce participation. Trust fund sustainability, the looming financial challenge. Perhaps the most significant long-term issue facing Social Security involves the projected depletion of its trust fund reserves, currently estimated to occur within the next decade. This timeline represents a critical challenge that demands legislative attention and potentially difficult policy choices about benefit levels, contribution requirements, or eligibility parameters. The trust fund serves as Social Security's financial buffer, accumulating surplus contributions during periods when income exceeds expenditures and drawing down reserves when the relationship reverses. Demographic shifts, including declining birth rates and increasing longevity, have fundamentally altered this balance, creating persistent deficits that gradually erode accumulated reserves. Current projections suggest that absent legislative intervention, the trust fund depletion could trigger automatic benefit reductions of approximately 23% across all recipients. This scenario would create unprecedented hardship for millions of retirees and disabled individuals who depend on Social Security as their primary income source, while simultaneously imposing substantial financial planning challenges on current workers approaching retirement. The political dynamics surrounding Social Security reform create additional complexity, as proposed solutions typically involve either benefit reductions or contribution increases that generate significant opposition. Raising the full retirement age further, increasing the taxable wage base, reducing cost of living adjustments, or modifying benefit formulas each carry distinct political and economic implications that influence their feasibility. Recent legislative actions, including benefit enhancements and tax modifications, have potentially accelerated the depletion timeline while providing immediate relief to current beneficiaries. This tension between short-term political pressures and long-term fiscal sustainability illustrates the challenging balance facing policymakers as they navigate competing demands from various stakeholder groups. Healthcare cost integration, Medicare's impact on net benefits. The interconnected nature of Social Security and Medicare creates complex interactions that significantly influence retirees' overall financial security. Medicare premium deductions from Social Security benefits mean that healthcare cost inflation directly reduces the purchasing power of retirement income, creating a dual exposure to medical expense increases. Medicare Part B premium projections for 2026 suggest substantial increases that could consume significant portions of Social Security cost of living adjustments. This relationship highlights the importance of considering healthcare costs as integral components of retirement planning rather than separate expense categories that can be addressed independently. The Medicare premium structure includes income-related monthly adjustment amounts that impose surcharges on higher income beneficiaries, creating additional complexity for comprehensive retirement planning. These surcharges apply progressive rate structures that can create unexpected tax cliffs for individuals whose income fluctuates around threshold levels. Understanding Medicare supplement insurance options becomes crucial for managing total healthcare costs, as original Medicare coverage includes gaps that can result in substantial out-of-pocket expenses. The timing of Medicare enrollment decisions relative to Social Security claiming choices requires careful coordination to optimize both coverage and costs. Strategic planning implications for 2026 and beyond. The convergence of multiple Social Security changes in 2026 creates both challenges and opportunities for effective retirement planning. Understanding these modifications enables individuals to make informed decisions about claiming timing, work continuation, and overall retirement strategies that maximize their long-term financial security. The interaction between delayed retirement credits and the evolving full retirement age structure creates particularly compelling incentives for extended work among those who can afford to delay benefit claims. The combination of 8% annual benefit increases and unrestricted earning potential beyond full retirement age provides substantial rewards for continued employment. Tax planning considerations become increasingly important as Social Security tax limits rise and Medicare premiums increase, affecting both current contributions and future benefit taxation. The complex rules governing Social Security benefit taxation require careful coordination with other retirement income sources to optimize total after-tax income throughout retirement. Estate planning implications also warrant attention, as Social Security benefits generally terminate at death while accumulated assets can transfer to beneficiaries. This reality emphasizes the importance of building complementary retirement savings that provide both current income and legacy preservation opportunities. The uncertainty surrounding long-term program sustainability adds additional complexity to retirement planning decisions, as individuals must balance current optimization strategies with potential future benefit reductions or eligibility changes. Diversifying retirement income sources and maintaining flexibility in claiming strategies becomes increasingly important given these uncertainties. Conclusion: navigating Social Security's evolution. The changes coming to Social Security in 2026 represent significant adjustments that will influence retirement security for millions of Americans. From modest cost of living increases partially offset by Medicare premium growth to the final implementation of the 67-year full retirement age, these modifications require careful consideration and strategic planning. Understanding the interconnected nature of these changes enables more effective decision-making about retirement timing, work continuation, and overall financial planning strategies. The complexity of Social Security rules and their interactions with other retirement programs emphasizes the value of professional guidance and comprehensive planning approaches. As demographic pressures and fiscal challenges continue to evolve, Social Security will likely face additional modifications in future years. Staying informed about these developments and maintaining flexibility in retirement planning strategies will remain essential for optimizing long-term financial security in a changing environment. The program's fundamental role in American retirement security ensures that Social Security will continue adapting to meet evolving needs and constraints. Successfully navigating these changes requires ongoing attention to policy developments, strategic planning, and careful coordination with other elements of comprehensive retirement preparation.